Hey guys, Carl Allen here. Welcome to module number 7 of Dealmaker Empire. We are almost home. We've just got one more module after this one. So module 7 is all about financing your deal. Here are the 5 lessons that we have for you in module number 7. So in lesson number 1, I'm going to walk you through the different ways to use the assets on the balance sheet of the business to generate the financing so you can make a closing payment in your deal. In lesson number 2, I'll get into seller financing, and that's the quickest, easiest form of financing that you can have in your deals. In lesson 3, I'll go into equity financing. So instead of raising the financing that you've got to pay back, equity financing is when you're partnering with investors who will buy shares in the business and hopefully add a lot of value to you and the business. In lesson number 4, I'll walk you through the entire financing process, the soup to nuts, start to finish process of raising the finance to put into your deal. And then as normal, we'll finish with an implementation lesson. So to that point, let's just quickly review the implementation work for module number 6 last time, which was offers and negotiation. So there's 3 things that you should have done in the module 6 implementation. You should have created your offer sequence by incrementally improving the value of the deal without changing that all-important cover ratio, that critical metric that we judge all of our LBO deals on. And hopefully you've done that. You've submitted your opening offer and you've mapped out what your negotiation strategy is going to be as you start receiving your counter offers on your deals. So hopefully you've done that work. If you haven't, stop now, go back and get the implementation done. I want you to be implementing this every single week. So if you've done the implementation, let's move on to today's lesson about asset-based lending or asset-based financing. So I'm going to walk you through the 6 different ways that you can use debt financing in your deal. The first is through the business's working capital assets, including the cash in the business, accounts receivables, and inventory. All those things are sat on the balance sheet. And I'll also walk you through how you can use fixed assets, real estate, cash flow, lines of credit, and the SBA 7A loan process as other potential ways to raise financing. There's a full detailed bonus on the ins and out of the entire SBA 7A loan process, but I'm going to touch on it as part of this lesson anyway. So let's talk about working capital assets, starting with cash. Now, when we talk about using cash to finance a deal, what we're really talking about here is any surplus cash in the business, and that's cash over and above what the business needs to continue trading. So if the business has got more cash inside of it than you actually need to run the business, you can use that cash to help finance a closing payment. And we typically want to reserve about a month's worth of sales revenue in the bank account. So we take the annual revenue of the business for the last 12 months and we divide it by 12. Or if you want to round it up, just use 10% of the annual revenue of your business. So that's the minimum amount of cash that we ideally want to see inside of the business on the day that we acquire it. So let's say you're looking at a business doing $1.2 million in annual revenues. So using 1/12 of that is $100,000. Though we use that simple math at this stage, it will get fine-tuned as part of the deal closing. And when we get into module 8, one of the things that we'll do as part of the financial due diligence is build a 12-month future cash flow forecast, because most businesses have some degree of seasonality. They're not generating the same revenues and same profits every single month. They could be up one month, down another. And in some cases, it could be quite severe. It could be quite choppy. So I'll show you how to calculate that so that we can fine tune what our minimum cash requirements need to be. But at this stage, when you're looking to put together an entire funding mix for the deal, just work off 1/12 of the annual revenue to determine that minimum cash amount. So let's say the deal that you're looking at needs a minimum of $100,000 to trade, but there's actually $500,000 of cash in that business. So the extra $400,000, that is considered surplus cash because it's not needed to run the business. So you can use that surplus cash as part of your financing mix. Next, let's talk about accounts receivables financing. There aren't many leveraged buyouts that I've done where I haven't used some sort of accounts receivables financing, or AR financing for short, for that closing payment. In Europe, it's called trade debtor financing or confidential invoice discounting, CID. But in the US, it's accounts receivable financing or AR financing. Essentially, you're leveraging the buck of unpaid customer invoices. And depending on what credit terms you've given, whether it's 7 days, 30 days, 60 days, 90 days, or even longer, at any moment in time, your business that you're acquiring will have a large buck of unpaid customer invoices on the balance sheet. And the great news is you can borrow money against a percentage of those invoices to help fund a closing payment. So AR financing is a revolving line of credit. So you use this also as a facility once you've acquired the business. It's a revolving debt facility that you only need to pay the interest on. You can keep the debt within the business as you continue to trade versus having to pay back all that capital like you would with a traditional amortizing loan. Let me show you how. Now, I don't want you to get confused between AR financing, where you're effectively raising money secured against those invoices, versus factoring. Now, factoring is when you sell the invoice to another company, which then collects the money on your behalf. Now, I don't like factoring, especially when you're doing a deal, because when you factor, you sell the invoice to a third party for, say, 80 cents on the dollar, and then that third party can generally employ some very aggressive credit control tactics to collect that money from the customer. So I guess it's a bit like the mafia doing debt collecting, and you don't want that because that kind of really aggressive tactic can harm the relationship that the business has with those customers. So instead, AR financing, it's a lot more gentler. It's all about leveraging that buck of unpaid customer invoices. Now, there are three key variables that affect the amount of AR financing that you can secure. We generally use, say, 80% as a blended average, but when you offer up the invoice bucks to receivables lenders, they apply these first three variables. So first, you can only typically finance invoices that are less than 90 days old. Some financiers will go longer to 120 days, but beyond that, they're disallowable because the financier is going to think, well, if these people aren't paying their invoices within 90 or 120 days, then they're probably not going to pay them at all. So they don't finance those, they disallow them. The second variable is concentration. So if you're buying a business that's doing $1.2 million in revenues, but it's only got 2 customers and 50% of the business is with each customer, then unfortunately, you're not going to get a lot of financing on those receivables, because if either of those businesses didn't pay you, the bank is going to be at significant risk. So AR financiers typically limit customer concentration as a percentage of revenue. And while it depends on the sector and the country and the particular financier that you're using, generally, they don't want you to have one customer that's going to contribute more than 25% of the business's total revenues with that much unpaid on the balance sheet. So concentration is quite key. Now, the third variable depends on the business's customers' credit ratings. So banks will only finance invoices that are being presented to companies that have decent credit ratings, because the financier will take out credit insurance on this AR financing loan. So let's say GE was one of your customers. Obviously, it has a AAA credit rating. So the financier is going to take out credit insurance against all GE's invoices. So if GE doesn't pay the invoices for whatever reason, then the financier can get the money from the insurance company. So when you layer in those three variables, we're typically looking at around 80% as a blended average loan to value. So if you've got, say, a $500,000 book of accounts receivables, you can generally look on planning around $400,000 in financing from those invoices. And once you offer up the actual AR information to the financier, they'll run the numbers, they'll look at the business, and they'll tell you exactly what that percentage is going to be. Because AR financing is not only great for getting some quick cash into the deal for a closing payment, but it can also be used to solve any cash flow problems that you might encounter as you trade and as you grow the business once you've acquired it. And it's like getting your cash, your customers paying you inside of 24 hours. And it's fairly cheap debt as well, less than 10% interest per annum, including all the fees and all the audit costs. So let's look at a quick example. Say you're buying a business that's doing $1 million in revenues and $100,000 of profit or free cash flow. And you're buying that business at, say, a 2.5 times multiple from the valuation lessons that we've done. So it's a $250,000 purchase price. And let's say you're going to structure that deal with $150,000 as a closing payment and then a $100,000 seller financing payment. So let's assume that the AR, the accounts receivables, is on average about 90 days of revenue. So the balance sheet AR would be $1 million multiplied by 90 divided by 365. So you've got $250,000 on the balance sheet for accounts receivables, meaning roughly 1/4 of the annual revenue is sat on the balance sheet in unpaid invoices at any moment in time. So an 80% loan to value would generate $200,000, which means you can get $200,000 of cash by financing the AR to buy this business. And let's say you use $150,000 for your closing payment, then you've got $50,000 of surplus cash left, which you can use for working capital or for closing costs or fees. And if there's anything left, by all means, take it out of the business for yourself. So if $200,000 goes into the deal, now look at what happens with this revolving line of credit. So for the next 90 days, those invoices, they get repaid. So when the customers repay those $250,000 of invoices, that money goes straight back to the financier, but the financier only takes back the $200,000 that they've lent you. Thank you very much. That's what they've lent you. That money's discharged, and then the $50,000 of extra cash comes back to you. But you continue to trade the business and you continue to trade the facility. And let's say you start to grow the business. So let's say the invoices that you send out within that next 90-day period, they total $300,000 because of the new revenue that you're bringing in. And if you factor that over the next 4 quarters, you'd have $1.2 million in annual revenues versus the $1 million that you had when you acquired it. So you just drop that $300,000 straight into the same accounts receivables facility. And at the same 80% loan to value ratio, it means you've now got $240,000 in instant cash. You get that cash within 24 hours of uploading the invoices into the system, and round and round and round she goes. It's rocket fuel. I absolutely love AR financing. So next on the list of asset-based lending options is cash flow. So over that next 90-day period, you're generating $290,000 of free cash flow. So you've got the $200,000 of AR financing that was raised. You use that money to do the deal. The customers, they pay their $250,000 of invoices back. The bank takes its $200,000 back, leaving you with the $50K surplus cash plus the $240,000 of new financing that you're generating on your new invoices. So your free cash flow during that period is $290,000. Brilliant. Next is inventory financing. So inventory financing works very, very similar to AR financing, but it's always a much lower loan to value ratio. So you're generally looking at between 30% and 50% of the cost of the inventory. And it really depends on a couple of things. First is the quality of the inventory and what it is. So if you're buying, say, a food business, then you're not going to be able to finance food inventory because obviously it's perishable. And if you've got a really high quality inventory, the other issue could be the pass-through of that inventory. So let's say you're making components, you're buying an engineering company, and let's say that company has a 20-year supply contract for, say, components for the Airbus 380 aeroplane. So you're manufacturing, say, the bolts that fix the window frames into the fuselage of the plane. So every time that they make those planes, they're going to be ordering those components for you. So you're going to have, as part of your contract with Airbus or Boeing or whoever, an absolute ton of these components ready and made in your warehouse, because you don't know how many they're going to order at any one moment in time. So with a high quality component like that, that's not perishable and it's subject to a contract, you're going to get 50% financing as a minimum, because even though it's high value and it's backed by a contract, the financier knows that you're going to be passing those components through to that customer at a markup, at a profit. Now, inventory financing is based on the cost of the inventory, not the retail value. So let's say you've got $10 million worth of components. That's what they're worth when you sell them to Airbus, yet it only costs you $2 million to make them. So you'll only get 50% on the $2 million. So you'll only get $1 million of financing on that inventory. But that could be enough to make the difference in getting a closing payment that works for your deal. So it's always good to look at inventory. Next is fixed asset financing. So things like computers, machinery, trucks, trailers, cars, loads of different things, but not real estate. We'll cover that separately. There are two ways that you can finance the fixed assets in the business. One is to simply take 50% of the depreciated value of those fixed assets on the balance sheet of the business, because obviously when you buy a machine for, say, $1 million, within 5 years, it's probably only going to be worth $250,000, $300,000 because it's depreciated over that time. So a financier will give you 50% on average of that depreciated value at the time you do the deal. So some financiers will do that. Other financiers will also use a fancy term called NOLV, which stands for Net Orderly Liquidated Value. And what that means is they'll figure out what the equipment would be worth if they had to do a fire sale within 2 to 4 weeks to get their money back. So obviously, let's say the business failed for whatever reason and the bank wanted the financing back, they'll take an NOLV appraisal. So obviously that generates a lower value than what it's listed for on the balance sheet, but then they'll apply a slightly higher loan value percentage, say 75%. And that generally nets out to around 50% of what the depreciated balance sheet value is anyway. And what we can also do with fixed assets to get more money is to do something called a sale and leaseback, meaning that you actually sell the assets to somebody else, a financier, but you keep them in the business, keep using them, but then you lease them from whoever's bought them. So let's do an example. Let's say you've got $500,000 of fixed assets on the balance sheet and you sell them to a financier for the same amount. So this gives you $500,000 of cash, which you can then use to fund the closing payment. So those assets will physically stay in the business, but they'll come off the balance sheet and the asset register of the business. And then what you're doing is you're just leasing them back for the financier that's bought them. So let's say the lease was done over, say, 5 years at 10% interest on $500,000. That'd be $10,624 per month that you'd be paying back to the financier. But you've got the $500,000 of cash that you can put into the closing payment mix. And it would be a simple analysis. So you'd actually be paying around $137,000 in interest over those 5 years, which you think, well, wow, that's a lot of money. But if this was the difference between you buying the business and not without using your own money, then I don't know about you, but I'm pretty sure that you would do it. So next is real estate financing. You can generally get around 75% loan to value on a real estate asset. And remember, the real estate value is treated differently to the value of the business. They're separate, but whether you want to use the real estate in a deal or not, it can sometimes be used to skew more of the closing payment into the deal. So let's say you're buying a business that's worth $500,000 and it's got $400,000 worth of real estate. So if you're just buying the business, you'd be paying $500,000. If you're buying it all, you'd be paying $900,000. And let's say there are no other assets in the business and you can't generate any other financing externally whatsoever. So the only way you could do that deal is with 100% seller financing for the business. But the seller will say, well, actually, no, thank you. But by bundling in the real estate, all of a sudden, you can get $300,000 of cash financing, or 75% of the $400,000 piece of real estate. So now you've got $300,000 as a closing payment, and that could be enough to tip the seller over the edge and do the deal with you. But if you don't want the real estate and you prefer to lease it, then by all means do that so you don't have to finance it, obviously, as part of the purchase. But if that's what you're going to do, what you then need to do is you need to lower your valuation for the business by adjusting the EBITDA for that annual rental cost. So if you're buying a business that's doing $100,000 a year in profit, and it's going to cost you $20,000 a year to rent the real estate from the previous owner, then obviously you've got to lower the profitability by that amount before assigning your multiplier. So $80,000 in this case. And you can also include an option in the deal to purchase the real estate later. And in this case, the seller keeps it, and as it grows in value, it generates additional income for the seller over and above what you're paying them to buy the business. Or you can do a back-to-back transaction. So if neither you or the seller want the real estate, yet taking the real estate is going to be pivotal for you to close the deal, then you can sell it to a third party. Sell it to a real estate investor who might be able to do their own deal with 100% financing, because you're selling that real estate to them with a contract to rent it back within the business. And they'll be able to finance it based on what that rental yield is going to be. Next is cash flow lending. So cash flow lending can be really common for the following reasons. Number one, it can be used to top up all of the other asset-based lending in your deal. So let's say you're buying a business, you need $1 million closing payment, but you've only raised $800,000 through financing all the things that we've just talked about. And let's say you're a couple of $100,000 short and you just can't get the deal closed without raising that extra money, then a cash flow lend could be used to give you that extra financing. And cash flow lending can also be used for deals where there are really, really good profits, but no assets, like in a technology company or an online business, or anything that's B2C, business to consumer, or any professional services companies that don't have invoices. They just take credit card payments and get paid up front. So cash flow lending is based on a multiple of what the annual cash flow is, or more often than not, financiers will use a multiple of EBITDA. What you'll find is the more cash flows that are recurring, the better you can command a higher multiple. So if you're buying a business that's got, say, a 5-year contract with a customer, and that cash flow is recurring, you'll get a higher multiple on that than just normal cash flows from hit or miss customers. And financiers will lend generally up to 3 times what that cash flow number is. And it's averaged over the past couple of years. And then the loan is amortized typically over a 5-year period. So you're paying it back within 5 years, the capital plus the interest, but that's a short time frame. But if the cash flows of the business support it, you'll have seen that from doing your simple models. Now, a drawback of cash flow lending typically involves some form of personal guarantee, which in some cases you can insure, especially in the UK. However, you do need a cash injection or equity injection, which is generally around 20% of what the total cash flow lend is going to be. So if you don't have cash in your existing business to do that, you might need to go and sell some equity in the deal to an investor that's going to generate that cash to be able for you to leverage that cash flow lending. So let's look at a quick example. So let's say you're buying a business, and let's say it's a $500,000 purchase price, $500,000, and it's got a $100,000 in EBITDA. So you're buying at a 5 times multiple. And let's say it's a technology company or it's a thriving online business, and you've agreed to a deal where you're going to be paying $250,000 at closing and then $250,000 in seller financing. But there's no assets in that business whatsoever. And let's say the EBITDA last year was $125,000 and the EBITDA this year was $100,000. So the average EBITDA over those 2 years is going to be $112,500, unless you assume the financier gives you a 2.5 times multiple on the EBITDA or the free cash flow. So that means that they're going to give you $281,000 as a total cash flow lend. But you've got to provide 20% of that, which is $56,000. And that will make the net financing $225,000. So your total cash in the deal is going to be 281. Your closing payment is $250, and that leaves you with a nice $31,000 surplus. So if you're putting up the $56,000, you could be paying yourself back $31,000 of that very, very quickly. Now, if the business has got existing lines of credit, LOCs, you can also potentially draw on them for the acquisition financing. So let's say you're doing the same deal as before. So $500,000 purchase price. It's $250,000 at closing and $250,000 in seller financing, and there's no assets. And let's say the company banks with Wells Fargo. And 2 years ago, good old Wells Fargo gave that business a $300,000 line of credit that they used, but they paid it back. However, the line of credit is still there, and the banks want you to keep the lines of credit so that whenever you need it, you can borrow more money and the banks earn interest. That's how they make money. So let's say you fully draw on that $300,000 line of credit and you use it for your acquisition financing. So here again, you've got the $250,000 closing payment and $50,000 as surplus cash. Finally, let's touch on the SBA 7A loan. Now, again, there's a comprehensive bonus training on this, but let me give you the highlights here. So the SBA 7A loan is only available to US citizens, and for deals, they have to have 51% of US shareholders, including look-throughs. So let's say you've got holding companies and other various different legal entities that you're going to use to buy the business. 51% of the people, the shareholders, the members, right the way through that chain of businesses, they need to be verified US citizens. Now, the other rule about the SBA is that the seller can't retain any equity in the business. It's got to be a 100% buyout. The owner can't even stay on as an employee. So go back to your offer sequencing. If part of your deal structure was to leave the seller with 10% equity, then unfortunately you can't do an SBA loan. It's got to be 100% of the buyout. But if you want the owner to stay around for a bit as a handover period or even do some business development work for you, then you can hire them as a third-party consultant, but they have to come off the corporate payroll of the business. Also, SBA 7A loans are capped at $5 million US. So you can have a larger deal though with seller financing. So let's say the business was a $10 million valuation. So you could do a $5 million SBA loan and then a $5 million seller financing as well. So quick example, let's say you were doing a deal, it was $4 million and you wanted to do it through the SBA. And it was a small deal. The SBA would underwrite 85% of the loan up to only $150,000. But since this is a much bigger deal, it's much greater than $150,000, the SBA would only underwrite 75% of the financing. But the SBA actually doesn't provide the financing. They use partner banks like Livo, Wells Fargo, Chase. There's loads of SBA financiers in the financing Rolodex that we've provided for you. And the partner bank, if they choose, can top up the loan up to a maximum of 90%. That's at their discretion. But you typically find that the average SBA-backed loan is around 80% loan to value. So on a $4 million deal, the SBA is going to be kicking in 80% or $3.2 million. And it's great because you can have a minimum 10-year repayment period. Now that remaining 20%, 10% of it has to come from you, the buyer. So in this case, that would be $400,000. If you've got those resources inside of your existing business, then great. If you haven't, you can sell shares to an equity investor in your deal who can partner with you. And then finally, the seller will need to secure the remaining 10% with what's called a seller standby note. So it's seller financing. Now this says that the seller won't get that final 10% or that final $400,000 until the SBA loan has been fully repaid. So don't be fooled when you look at a deal presented by a broker and the broker tells you that the business is SBA pre-approved. That is an absolute myth, my friends. There's so much that goes into an SBA application. It is impossible for the SBA to approve a deal before they know who the buyer is. The buyer's ability to take the business, to grow it, to make it even more profitable is more important in a lot of cases, even more so than the numbers. So the advantages of the SBA are it generates 90% of the total deal paid at closing, which means because you're giving the seller 90% of the total deal at closing, you can negotiate a much lower total valuation. And because the repayments are over 10 years at a minimum and they're at less than 10% interest rates, it's a much easier debt to service. And remembering the simple model where we're looking at cover ratios, if you're paying the loan over 10 years, your cover ratio is going to go up. But there are a few disadvantages with SBA loans too. First of all, shareholders that own more than 20% of the business need to personally guarantee the loan. And you need a minimum of 10% cash equity to close an SBA deal, even though it doesn't have to be your money. And the SBA fees, they're a little bit expensive. Generally, it's a 3% packing fee. So 3% on the 3.2 million loan, yeah, that's $96,000. It's a lot of fees that you've got to pay to the SBA just for the privilege of using their money. And it's bank fees as well. You've got to pay the bank legal fees, which in the last SBA deal that I did was around $20,000. So the SBA is what I call a lender of last resort, but sometimes it could be just the infusion you need to get a deal over the finishing line. So again, check out the bonus report to learn more about SBA-backed loans in a lot more depth. So that's it for asset-based financing. I'll see you on the next lesson, which is all about seller financing and earnouts. Until then, bye for now.